Hello, thank you for joining me today on Reverse Mortgage Radio. I'm your host, Bruce Simmons, and today we're going to talk about choices. Because with reverse mortgages, there's tons of choices. This is such a customizable program. Reverse mortgages, you can make them any way you want, just about, assuming you have enough equity. But the choice we're going to talk about today is, should you do it now or should you do it later? I'm assuming you're going to do it eventually. That's the thing that I like to do here. But what we're going to do is we're going to compare the different ways, the pros and cons. We're going to weigh them out and see which one makes more sense. Now, obviously, it depends on your specific situation. That's why I think it is so important to gather the facts now, even if you can't qualify right now. Let's say you're 62 or 65 and you're not even planning on retiring for another few years, but you need to have your options figured out a little bit. You need to decide, is this even an option? If you live in a $600,000 home and you owe $500,000 on your existing mortgage, well, it's not going to, reverse mortgage is not even going to be on the table for a number of years until the value of your home goes up and your loan balance comes down and you have enough equity to be able to do it. Because the way reverse mortgages work is the amount of money you qualify for on a reverse mortgage, it really doesn't have anything to do with your credit or your income or any of that stuff. It has to do with the age of the youngest homeowner, the value of the home, and the interest rate. I know it's kind of weird. Interest rate. How does interest rate play into it? We're going to talk about that. If you have any questions about reverse mortgages while you're listening to the show or later in the week, write down my number. My phone number is 303-467-7821. That's my direct line. It rings right to my cell phone, 303-467-7821. However, don't text me at that line because that line actually rings to a landline that's in my house, in my basement. I got that line back in 1999 when I first ended up getting laid off when I was managing a mortgage company, and they laid me off, and I said, hey, I could do this on my own. So I just opened up my own mortgage company out of the basement of my house. Back then, there was no licensing or anything. But that line rings to a landline, or that phone number rings to a landline. Then I have it forwarded to my cell phone 99.9% of the time. Again, it's 303-467-7821. My name is Bruce Simmons. I've been specializing exclusively in reverse mortgages since 2003, and it's the only loan that I've done for the last 20 plus years. And I love what I do. I know what I'm doing. I'm good at it, and I enjoy helping people with this program. You can also visit me online, though, at reversemortgageradio.net. Reversemortgageradio.net is my website. And next week, usually Monday or Tuesday, my web guy has the radio show on my website. So if you have to go and you want to listen to the show, then you can tune in next week on my website and listen to the podcast. It's also available, I think it might be on iHeartRadio. I'm not sure exactly where all the different places my podcast is available, but it's definitely available at reversemortgageradio.net. So thank you very much for joining me today. Let's talk about the pros and cons of doing a reverse mortgage now versus waiting to do it later. However, before we get into that, I do want to mention about kind of how we calculate the amount of money that you qualify for, because that's an important part of whether or not you're going to do the loan now or later. Real quick, a reverse mortgage most of the time is an FHA insured loan. FHA is for the Federal Housing Administration, so it's a government-insured loan, and it's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can spend however you want. Now, we do have to pay off any existing liens or outstanding loans that are on your home. If you have a loan of $100,000 on your home, and you qualify to receive $150,000 from the reverse mortgage, the first 100 of that 150 that we can loan you has to go to pay off the existing mortgage that you currently have on the loan. And the nice thing is, by doing that, you eliminate that principal and interest mortgage payment. Now, the house is still yours. You have to continue to pay your own property taxes, your own homeowners insurance. You have to maintain the home, live there as your primary residence, and keep your name on title. As long as you do those 5 things, you can never, ever, ever be kicked out of the house. It's your house. You can paint it purple, add a bedroom, whatever the case may be. You can't tear it down. You have to continue to live there. If you scrape the home to build a nice new one, you're no longer living there. And that's going to prompt the loan to come due. But as long as you don't do that, you're okay. The reason I say all this is that also too, the way we calculate how much money we can loan you is based on 3 factors. Okay, FHA dictates to us, the lender, how much we can loan you. It's based on the age of the youngest homeowner, the value of your home up to the FHA lending limit, which is currently $1,149,825, and also the interest rate. A huge one is the interest rate. That's the biggest factor. Just a small change in the interest rate up or down can have a pretty substantial effect on the amount of money you qualify for. And we're going to talk a little bit about that today. But essentially, the older you are, the more money we can loan. The higher the interest rate, the less money we can loan as a percentage of the value of your home. The reason is, as the interest rate goes up, FHA looks at this and they say, hey, the money you borrow from the reverse mortgage is going to grow at a faster pace because no mortgage payment is required. No principal and interest mortgage payment is required with reverse mortgages. However, you're still charged interest every month. The interest that you're charged but not having to pay gets added to the loan balance. Your loan balance grows larger every single month if you don't pay it. And what happens is that FHA looks at that, they say, okay, well, if the interest rate is growing at 8% as compared to, say, 4%, the balance is going to grow at a lot faster pace, and you're going to end up owing more money down the road. So we're going to compensate for that by reducing the amount of money we allow you to borrow today. Hopefully that makes sense. If not, please pick up the phone and call me. I'd be happy to go over it with you and run a scenario for your specific situation. My direct line's 303-467-7821. So that's a huge factor right now. Rates went up so fast and so much, they doubled. The rates doubled in the span of just a couple of years, from 2022 to 2024. Well, less than 2 years, 18 months. They started really going up in May of 2022, and here we are now almost May of 24, and the rates have gone up and they've come down some. They've gone up and they're staying high, I think, for a little while. I think they're going to stay high for quite a while, actually, probably decades in my mind. But even if the Federal Reserve lowers their federal funds rate, I don't know that it's going to affect reverse mortgages tremendously. And that's a whole nother topic for another day, and it has to do with the amount of money our federal government is spending, which I'm sure if you listen to the station, you're probably on the same page as me with your dissatisfaction in that. But let's talk about the pros and cons of waiting to do a reverse mortgage. So number one, if you wait to do a reverse mortgage, let's say you wait a year, you're looking at it today, you qualify to have enough money, you get enough money today, you could pay off your existing mortgage or whatever today. But you say, you know what? I think rates are coming down, and I think I want to wait to do the reverse mortgage. Well, number one, if you do that, one of the pros of that is you're going to be another year older. And the older you are, the more money we can loan. It's not a ton of money, but let's say it's about $2,500. It depends. If you've got a $1 million home, it might be $3,500. If you've got a $350,000 condo, it might only be about $1,500. Let's just say you're middle of the road. That might add about $2,000 to $2,500 to the amount of money you qualify for. Your property value might increase. Let's say you have a $600,000 home. If your value goes up by 4% this year, that'd be $24,000. Your value increases by $24,000, which is a good thing. Also, too, let's say you do have a mortgage on your home and you're paying it down. You've reduced the loan balance. Now, depending if you've refinanced like in 21 or 2020 or 2021, you're probably not getting a ton of principal reduction, especially if you did a 30-year mortgage. And so my scenario here is somebody that's like 70 years old with a $600,000 home. If you did a 30-year mortgage at 70 or 68 or whatever, you're going to be paying that mortgage for the rest of your life. Number one, that's not a very, very attractive proposal in my mind at that age to be doing it. But I've heard of people in their 90s getting for regular traditional mortgages with mortgage payments. And it's like, I don't think I'd want to do that myself. Okay. So those are the three pros of waiting. You're older, so you get qualify for more money. The value of your home is increased, so you can get more money. And your loan balance has decreased a little bit. So the net amount to you, even if the loan balance, the amount you qualify for was exactly the same, it takes less to pay off your existing mortgage. So that means more money to you that's left over. Okay, now the cons, the three negatives with waiting to do a reverse mortgage. What if rates go up? You say, okay, well, rates could come down. Yeah, they could. They could go up. I think I hate to be, I'm not a good prognosticator on this, but I don't think they're going to change a whole lot. They might come down a little. They might go up a little. It'll probably do both over the next 12 months. But you also sacrifice what's called line of credit growth rate. The line of credit with a reverse mortgage, if you've ever heard me talk about reverse mortgages on this show before, I talk a lot about the benefits of having a line of credit. The way it works, let's say you have a $600,000 home and we can loan you $200,000 on a reverse mortgage. If you have a $200,000 mortgage on your home, all we could do is pay off that existing mortgage and there wouldn't be any money left over. But let's say you only owe $100,000 or $150,000. Let's say $100,000, okay? Let's say you owe $100,000 and we can loan you $200,000. The first $100,000 pays off your existing mortgage. And you say, hey, Bruce, that's all I want to do. I don't need any more money. I don't want any more money. All I want to do is pay off that existing mortgage to save myself the principal and interest. Well, that's fine, but FHA tells us, the lender, they tell me how much I can loan you. I have to make that money available to you. You do not have to take it. We leave that money, in this scenario, we set that $100,000 aside in a line of credit. That's available to you if you ever need it. If you never use it, you never are charged any interest on it, but it's available to you. So that $100,000 sits there in a line of credit. Well, it doesn't just sit there like a traditional home equity line of credit and stay the same. It grows over time. It's got a built-in growth rate that's 0.5% greater than the interest rate you're charged on your loan balance. So every month, you're charged interest on whatever money you take out. In this case, you're pulling out $100,000. You're charged interest right now, let's say it's 7.5%. You're also charged mortgage insurance. All FHA loans have mortgage insurance, and that's to protect in a couple of ways. It protects that line of credit that's available to you. Let's say 10 years goes by, and the lender that's servicing your reverse mortgage goes out of business. But you need the money now. Suddenly, overnight, boom, you need the money. What are you going to do? FHA guarantees that money is going to be available to you. Also, let's say you use that $100,000 and then the interest rates go up as high as they can and you end up upside down on your house. 2008 happens again. The value of your home plummets and you owe more on the house than it's worth because the interest you're being charged on the money you've borrowed is continuing to grow, but the value of your home shrank. Now your home is only worth $300,000, but you owe $600,000 on the reverse mortgage. Well, as long as you live in the home and paying your taxes and insurance and and maintaining it, it doesn't matter. You can continue to live there because FHA guarantees to the lender they're not going to lose any money. So then you pass away, the heirs inherit the home, but they do not inherit any debt beyond the value of the home. So normally, if your home is worth $600,000 and you only owe $300,000, your heirs can sell the house, pay off the reverse mortgage, and take back the $300,000 in equity. Or they could keep the house and just refinance it and keep that equity in the house. But if you're upside down by $300,000, they sign the house over to the lender and walk away. The lender has zero recourse. They can never, ever, ever come after you, your estate, or your heirs for any loss because the mortgage insurance that you're paying for, or you're being charged for, I should say, is going to pay off the loan to the lender. So the lender's not going to lose any money. And what happens is that mortgage insurance gets charged to you in a couple of different ways. Number one, in an upfront fee as part of the closing cost, but also it gets added on a monthly basis along with the interest. You're charged 0.5% of the loan balance every year on your mortgage insurance, plus the 7.5% interest, let's say. So you're being charged 8% on the $100,000 loan balance. That means roughly a year from now, on that $100,000 you take out today, your loan balance will grow to $108,000. So if you wanted to pay the loan off a year from now, you'd have to pay roughly $108,000. I say roughly because it's charged, it accrues monthly. But that line of credit you've got available is also growing at 8%. So you have $108,000 available to you in a line of credit as well. If you did not do the loan today and you waited a year, you've lost that $8,000 worth of growth on that line of credit. Now, if you don't owe any mortgage on your home and you've got $200,000 in the line of credit, then that's even better. Then you're growing. You'd lose $16,000 in growth if you waited to do the reverse mortgage. Okay, so you're sacrificing that growth. That's the second con or negative. Number one is if the rate goes up, the amount of money we can loan you is going to drop. You're also losing the potential growth on that line of credit. The other thing, too, that people forget about is you're making another year's worth of mortgage payments. If you have a mortgage on your home, let's say you did owe $200,000 on your home, just because that's the way I did the numbers to set it up. So if you have a $200,000 mortgage, and let's say you did it 3-4 years ago and you got 3%, and I have a lot of people say, I hate to lose that 2.5% or 3% or 3.5% rate on my loan. I said, well, yeah, you can keep that interest rate. That's a great rate, but you can also keep that mortgage payment. Okay, if you want to get rid of the principal and interest portion of that payment, do a reverse mortgage. But let's say if you did a 30-year term, and granted, you're going to have that payment for the rest of your life if you don't do a reverse mortgage, but that's over $10,000 a month in just principal and interest that you're putting out of your pocket that you could keep in your pocket if you did the reverse mortgage now. Now, let's say you're smart. You're like, I did a 15-year loan because I didn't want to pay a mortgage for the rest of my life. So you're only going to pay it till, let's say, you're 85 or something, if you're 70 today. Or let's say you took it out when you were 67. You're going to pay it till you're 82. All right. And the thing is, too, a lot of people's health can really go downhill quick when you reach that big 80 number or on your way there. I saw it in my own dad. I've seen it in customers of mine. So it's important that if you can get out from under that mortgage payment sooner, the better. By the way, too, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage. You can reach me directly at 303-467-7821. 303-467-7821. That's my direct line. You'll reach my voicemail if I'm busy. Otherwise, I'll just pick up the phone. But also, you can reach me online at reversemortgageradio.net. reversemortgageradio.net. Today, we're comparing the pros and cons of waiting to do a reverse mortgage versus doing it now. Okay? So let's say, okay, the other thing I forgot too is people say, well, I think rates are going to drop. And if rates drop, then I'm going to get more money next year. And that's true. If the rates do come down, you could qualify for more money. However, you're still making that payment, let's say for another year. That's 10 grand. Or if you did a 15-year loan, that's $16,500 extra out of your pocket if it takes a year for the rates to drop. If you did it now, you're going to save that payment. You're keeping that extra principal and interest portion of that payment in your pocket. But also, too, you might be able to qualify for a refinance a year from now, too. And the closing costs are a lot less on refinances than they are on the first time you'd get a reverse mortgage. So you might be able to have your cake and eat it too, or what they call marry the home, date the rate. If rates come down, now, there's no guarantee they're going to come down at all. Honestly, I think they're going to come down. They're going to bounce back up. They're going to come back down and bounce back up. If you think you could time the market, more power to you. I don't think I would not bet on that personally. That's the way I look at it. But let's do some numbers. Let's look at some numbers. Let's say you're 70 years old. You have a $600,000 home and a $200,000 mortgage balance. Right now, okay, you do the reverse mortgage and you get just enough to pay off the loan. So we can loan the net amount after closing costs. We can loan, if you're 70 years old, would be about just under 33% of the value, 32.7% right now. If the rate dropped by a quarter point, which I don't know if it's going to or not, you get 1% more on the value. So we can loan you 33.8% instead of 32.7%. If the rate drops 1 full percentage point, which I don't see happening, but then we can loan you a fair amount more, because that would be 37% of the value of the home compared to 32.7% now. And that difference would be about $26,000 by waiting to do it. However, you have to subtract out the principal and interest portion of the payments that you've paid. However, if the value does go up, then you could get 37% of an additional $24,000. And these specific numbers aren't the best radio, and I apologize. There's pros and cons to waiting. And like I was talking to a financial advisor a while ago, and she had a client of hers who could have benefited from setting up a reverse mortgage now and getting out from under a mortgage payment and keeping more money in their pocket. They didn't feel comfortable about doing it, but I never talked to them. And I don't know that I really got this point across to the financial advisor about the importance of the growth of the line of credit, and also what happens if it changes. Because if the rates do come down, it is possible to refinance a reverse mortgage after a year. As long as you've had it for a year, rates come down, boom, you can refinance. And what a refinance would do at that point, because right now pretty much all reverse mortgage loans have an adjustable rate, a monthly adjustable rate. The reason is that's the lowest rate you can get, and it gives you the most money. So if the rates come down, your rate's going to come down too. You say, well, then why would I refinance? Because as rates come down, the percentage of the value that we can loan against your home goes up. If the rates did come down, we could loan you maybe 3 or 4% more money, or 5% of the value of your home more. And what that would do would be to increase your line of credit. Or maybe it allows you now to pay off your existing mortgage. Unfortunately, a lot of people I talk to right now, I can't loan them enough to pay off their mortgage. And what really gets me is I was not as diligent as I should have been back in 2022 when the Federal Reserve started raising rates. The consensus in everywhere pretty much was, come 2023, we're going to have a recession and rates are going to come down. The Federal Reserve is going to have to lower the rates come spring of 2023. Then it was summer of 2023. Then it was fall of 2023. They never came down. They kept going up. We're seeing the same thing now, and it drives me crazy. The end of last year, rates were going to come down, and they did. They dropped in November and December, and actually, I think it might have been January, February. I don't remember. January, February, I think the rates did come down because everybody was expecting the Federal Reserve to lower rates. They didn't do it. The inflation reports kept coming out higher and higher. And now we're looking at a very, very low GDP growth. We're at 1.5% GDP, gross domestic product, and we have high inflation. Anybody remember Jimmy Carter? Stagflation? I was a kid at the time, but I remember stagflation, that term. Are we headed there? I don't know. It's very possible we could see a recession. Interest rates are still going up because the inflation is continuing to go up. And a large part of that has to do with the federal government spending trillions and trillions of dollars that they don't have. Anyways, I'm getting off topic there. We just don't know what's going to happen. If you can qualify for enough to pay off an existing mortgage now, and it saves you $10,000, $12,000, $15,000 a year over the course of the year, why not do it? Do it now. And if something happens where rates do come down and we can refinance you, then you get the best of both worlds. But you're protected now and you're saving that money in your pocket now. Maybe it allows you to retire where you couldn't retire if you still had that $1,000 principal and interest payment every month that you had to shell out. So it makes a lot of sense to get the details. At least call me and get the details about your specific situation. Let's see if you even qualify. Unfortunately, a lot of people that I talk to right now, I can't qualify. I'm getting more calls now than I ever have. I mean, the last year or so, I've received a ton of calls, more than ever. But I can't qualify everybody because they owe too much money. And I can't loan them enough to pay off an existing mortgage that they have. Now that does, if you call me and I cannot help you right now, it doesn't mean that we can't help you, period. It just means right now we can't help you. If the rates do come down by 1%, maybe we could. I don't know that it's going to happen, but it's possible, right? Anything's possible. Give me a call with questions at 303-467-7821. That's my direct line, 303-467-7821. Or visit me online at reversemortgageradio.net. Reversemortgageradio.net is my direct line. And we can crunch the numbers, and you can weigh the options, pros and cons of doing it now or not doing it now, or not doing it at all, or doing it right now. But you can't do it yesterday. You can't go back to 2022 when rates were rising, but people thought they were high at 4%. Wouldn't, if only, right? Hope you have a great day, and look forward to talking with you next week.